Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another week of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer. We are for $99 a month. You get all of that, plus everything we offer in our web tools. And it's what we use here for the Quantcha Challenge itself. So we'll start off, as always, with a quick portfolio review. And there's a bunch of UI changes we made over the weekend, some really cool stuff we've added in. We'll get back to that later. We will cover that in a bit of depth. But I just wanted to cover the four stocks that we happen to be trading against right now. Carnival continues to be quite the workhorse for us. It's now, which we have a put credit spread in place because we're bullish on the stock. It is now pretty comfortably cleared that $55 strike for our short. So at this point, we're just kind of holding on to the hopes that it can stay above 55. We can collect as much of that credit as possible over the next 3 weeks. The next one is Micron. Micron we're bearish on, which so the movement down is good today. But if you recall, when we opened it up overnight, it started surging. So that trade unfortunately immediately turned on us. Which brings me to today's winner, Nvidia. I'm being a little sarcastic there, of course. We opened this up as a conservative low risk trade last week. It was trading around 160, so we opened up a put spread with about a 70% probability of success with a low strike of 150. Around this morning, they decided to cancel Christmas for all of us, and as a result, this 15% drop has really been quite a kick in the portfolio. We'll get back to talking about Nvidia in a little bit. And finally, we've got a complex position on Exxon. This is a combination of a spread, this -4 and this +4, which is a bearish spread we put in place a couple weeks ago, and then a pre-earning straddle we put on Friday with the hopes of being able to capitalize on some of the pre-earnings movement, and then of course the volatility increase. So, a couple things that we want to go through. The first one is we always start off with the high priority trades, and these are things that are trades that are existing positions we have in the portfolio that we either want to adjust or exit or scale or what have you. In this case, I'm going to call attention to Exxon. When we opened up this spread, this bearish call spread, so we got a credit for it, and at the time when we opened it up, the earnings was scheduled for, or the earnings was not yet announced, and the date was expected to be the week after the first. So we were thinking it was going to be the fourth or later, based on the best information we had and the implied volatility at the time. So we opened it up to close on February 1st because we did not want to have a bearish trade that included the earnings period. Unfortunately, they've since announced the actual date, and you can see here it's February 1st before market opens, which means that this call spread we have will not expire until after the earnings is cleared up. That's not great for us because it means that we won't really see a drop in implied volatility on the spread, and it won't approach zero really until the day of, which means we'd have to wait until the earnings is announced and hope that the earnings doesn't spike the stock upward. Now, the good news is we are positive on the trade right now, and we'll show that in a little more detail in a second. So what we're going to do, we're going to have to close it out before we get to the earnings date. And we have two options. I mean, one of them is we can just close it out now, take the profit we have, and just, take that risk off the table. And the other option we have is to wait a little bit longer, assuming we want to close, and then try to find a better opportunity leading into earnings where we can exit the trade. I'm a believer in the fact that since implied volatility is going to rise, it's going to take more movement. Like, it's going to take more than just a little bit of downward movement for us to be able to get more profit off this trade. So my view right now is to say let's just get out of it. We had a nice down day today that's putting us in a profitable position. We'll just take what we can and avoid playing earnings in this case. Now, the mechanics of closing it out, if it were a trade like the Nvidia or these other single spread trades where that's all we have in the book for that stock, we can come to actions and just say close book. We could do that here with Exxon and say close book. It'll give us a trade ticket, and then we can just come through and manually punch out the positions we don't want to have, and then we'd be looking at the trade just as we want here. The other option we have, which is often a more convenient way to do it, especially if you're looking to scale a position, like if we wanted to scale it down or scale something up, would be to go into the book manager, and we could say manage book, and this will give us kind of a little bit a lab to experiment with the holdings we have, and we can come in here and specifically pick out and say, well, we know we want to close this position and that position, and maybe we want to scale these up as well, or whatever. And as we find ourselves finally with the thing we want, we click trade, and it'll bring us to a ticket with just the changes we're looking to make. But stepping back for a second, when I hit those X buttons, it removed those from our pending book, meaning that we still have our current book, which is what we hold, and the pending book shows us what this would look like if we only had the positions that we've crafted ourselves into now. And this could involve adding stock or options using any of these uh, options down here, or it could be going out to our trade search or other features and bringing and sending those trades to our book. But what I wanted to call out here that's kind of good is right now our current portfolio has a beta weighted delta of minus 21, which means we stand to gain when the market drops, and that's generally good. It would have been really good for us today if we hadn't gotten blown out by that Nvidia trade, but by making this trade here, by closing it out, we'd bring ourselves back to a much more neutral delta, which would be nice. It'll actually increase our gamma a little bit because we're getting a bit of negative gamma from this trade, but we're not gonna hold on to that now. Yeah, so what we're gonna do is we're gonna place this trade now, and we're gonna try to close it. The other thing I should add is that Exxon's been up and down today. As you can see, it's sort of been rocking up and down. It was jostling. It looks like it's on its way up. I don't know that there's any reason for it to continue to move upward. So what we'll try to do is we're going to put in a trade here, and we're going to make this, it'll just be a day trade today. We're going to see if we can close it out at 70 cents. We opened it up with a credit of, I think it was 99 cents at the time. So closing it out at 70 cents means we get about 1/5 of the profit that we could have gotten. And so we'll just kind of throw this up there. We'll submit the order and let it sit for a bit. And I don't know that this is going to fill today. You'll notice we have 2 standing orders now for Exxon. The other one is our good till canceled order that we opened last week, and this one is just saying if we can close our other positions, our straddle, for $3, that we would take it. This one's just sort of a fishing line hanging in the water until it takes. If it doesn't ever fill, then we'll go back later on towards the end of the week before they announce, and we will close this manually. So we got that in position, and that's the main trade I wanted to get in place today. I also wanted to spend a little time going through and just kind of checking in on some of our earning strategies. So I'm going to step over to our screeners, and we have 2 save screeners from last week. One is an earnings 1-day calendar straddle. This is really just more earnings 1-day. Calendar straddle doesn't need to be part of the name of it. But the idea is saying, show me the stocks that are reporting either today or tomorrow. But basically, the stocks that either today or tomorrow is the last day to trade them before the earnings announcement. And then we want to have at least good liquidity and at least weekly options. The weekly options aren't critical if we're trading against a monthly expiration, but most of the time we won't be, so we'll just leave these as is for now. And we can see here that we've got 4 stocks that meet our settings. These are all, in this case, you can mouse over. The green means good or great liquidity, which means we should get a pretty tight bid-ask spread. We should have a wide variety of strikes to choose from. And the goal of liquidity is not just the specific pricing of the options. It also has to do with the volume and the open interest of the options, as well as the number of strikes and expirations available. We have a video that goes into depth on this, but the point of our liquidity rating is not just the pricing, but also how easily you can express a complex view for the trades you want to place, whether you're bullish, bearish, neutral, or trying to isolate one of the Greeks or what have you. So we can see all these stocks happen to be 1 trading day left. Actually, yeah, that's another thing I should point out is the 0 trading days left doesn't really mean anything, because that just means that you can't trade it until you can't trade it before earnings. If there's 0 trading days left, an example would be a stock that it's after hours today, and they've either already announced or they're announcing tomorrow morning, so you can't really do anything about it. That being said, so I like to sort by the earnings crush rate. This is our proprietary metric that helps us understand how the at-the-money options are expected to move relative to their volatility after the earnings is cleared up. Now, in this case, we've got 3M is showing a 55% IV crush rate. That means if we take a look at the stock, that, and this I've covered a bit in previous videos, but just as a refresher, this volatility of 47% or 46.5% is expected to drop to only retain 55% of its volatility, which means that the expectation is after the smoke clears when they announce earnings, we should see their volatility based on the option pricing expected to return to 25.5%. That would be either end of day tomorrow, or I mean, near the end of day tomorrow, or maybe the following day. It should settle in around that based on the pricing. However, the long-term IV mean, which is where we grab just a bunch of this long-term here, you can see these all settle in around, it's 23 and a half all the way down to about 21. So the mean is around 23.8, and this of course includes some of these as well. So it's going to be a little bit higher. So this is generally where they actually will revert to. So we have two numbers here. This is what the market's pricing those to drop to, and this is what is a more realistic expectation of what they'll probably drop to based on just historical observation. So we were able to take this value, subtract this value from it, and determine that there's about 171 basis points of overestimation of the value of the implied volatility in the at the money options immediately expiring after earnings. So in this case, this means they're a little bit rich, and that's why we call it the earnings ivy richness. Now, last week we found an opportunity with Granger where this was like, I think it was like 20%, like 2,000 basis points, and we traded it, and it was a relatively low risk trade for a great return, and we were able to double the investment on that trade. This 1.7 percentage points is not substantial, and it would be a lot harder for us to make a compelling trade here. So I don't want to spend too much time on this today, but suffice it to say, because it's in this range, we're gonna skip it. We won't get into that trade. And if I go back to our results, what we probably want to see is a number that's below 50%. That'll probably show us that there's a little more wackiness in the pricing of the week-to-week options. We could take a quick look at Verizon, come down, see 1.2 percentage points or 127 basis points. If we look at Allergen, here we've got this is a little more attractive. This is almost 300 basis points. So there might be a trade there. We're not going to place it today, though. And Biogen, maybe that'll give us something better. No, this one looks like it's almost perfectly priced relative to the two data points we are working with here. So in terms of screening, we're not going to do a trade for tomorrow morning. If we take a look at the pre-earnings 5 to 6 day straddle trades that we might have, this is the same setup as before, only we're looking at stocks that we have 5 to 6 more days, including today, to trade. And the idea for these ones is we're looking for ones that have a crush rate that is as high as possible. And the reason we want as high as possible is because this tells us that the value of the options, just historically speaking, the correlation from our experience is that the higher this crush rate is, the more likely or the more room the volatility for the earnings options has to move up between now and then. So in this particular case for Gilead, we can see that it's currently at 36.5% for the implied volatility. This may go up. In fact, it probably will go up, but we don't really have a good way to gauge it because right after it, if we take a look at the options around here, we end up with the earnings richness that's around 3.5 percentage points, and that's not bad. And this could be an opportunity. We're not going to trade this today, although we might keep an eye on it. This may show up tomorrow with any luck. And because we can see that they have 6 trading days left, 6, 6, 6. So we don't have anybody at this point who meets our requirements who is announcing. I guess if it's 5 trading days, that would mean they'd be announcing either after hours Friday or before market on Monday morning. There's just not a ton of stocks that do that. So we still have another day where we're going to be able to see all of these. I don't think at this point, one of the other things to keep in mind is we really can't trade the alphabet options because when you have a stock with that's this high, if we took a look at what their prices is for the straddles, so I'm selecting the first expiration after the earnings, and if I go into the option chain and I'm going to slide down to where the at the money options are, as shown where this line is, green is in the money, red will be at the money. If I just grab, let's say these are pretty close, you probably sell with a long straddle. No surprise here, it's going to cost us $6,200 to get in. Now, the trade like this, we're not going to lose most of the value. We're actually going to retain let's say worst case scenario is that the worst case scenario for us is that they move earnings. If they moved earnings out and all of a sudden the volatility of these options never needed to be as high as it is, right now the at the money volatility here is about 40%. If this dropped to 20% because they pushed earnings out another week, this would kill the value of our options and we'd get really hurt. But because it's not going to be moved out, almost surely not going to be moved out, or we have reasonable expectation that it'll stay and that these will be post earnings options, we will retain most of the value because the implied volatility will generally rise leading into the earnings date itself, just because there's more demand for long options in the market. Therefore, there's a requirement to pay more premium toward them, and then we can hope to collect that premium to offset any loss we have if we don't see the kind of movement we're hoping for in opening this long straddle position. But again, the issue here is this $6,200 is still a quarter of our portfolio. So in the event we lost 20% of that, that would be a $1,200 drop, which would really devastate us. And we're trying to trade this portfolio pretty conservatively. And so just for the sake of completeness, coming back in here, we probably should come in and adjust the pricing here, the equity pricing down to fit. Maybe the peak we could go towards might be in the range of stocks that are under $100 per share. I think those would give us options we could trade a little better. But for now, we're going to skip out on this. I'm going to come back and check in to see how we're doing on our Exxon trade. I suspect it probably hasn't come that close to closing yet. It looks like the stock continues to rise up a little bit. I'm not panicked in getting out of it. I'm still pretty bearish on it. I'm just worried that they're going to give us they might guide upward or something. I mean, after what Nvidia did to us this morning, there's really no telling what could happen here. So there's that. I did want to cover in the portfolio, we made a few changes. The first change to look at is we changed the way we were doing the delta and the beta weighted delta. It took a lot of space to say beta weighted on here, and on smaller screen sizes that was more it was more visible, and it kind of spread us out a little bit more and used a lot of space for this column. So what we've done is now what we do is we put the beta weighted delta in italics next to it to make it a little easier. So now we can see that your delta for the Carnival book is $60.25. So for every dollar that Carnival goes up, you might see about a $60 rise in the value of your Carnival book. The beta weighted delta means that for every 1211 that we see, for every dollar we would see movement in the S&P or the SPY ETF, we should see a $12 rise in the value of the Carnival book. And then we can consolidate those beta weighted deltas for each book down into our overall portfolio to get just that value. Previously, we had this consolidated down as well and just added up, but that value it's meaningless. It's really not useful. So we just kind of consolidate down, and you'll see it's in italics to indicate that it's part of the portfolio. And the same goes for gamma. Theta, Vega, and Rho, we're still just adding up just because that's how those work. And so those are just going to be straight values down the line that aren't dependent on the underlying movement they're not levered to any ETF or index or anything like that. So there's that. And the third thing is the option tab. The options tab is a view into the portfolio that's focused around the options you hold, breaking down the values. Now, we've had requests for quite a while to include implied volatility for options in the portfolio view. I'm not a huge fan of this, but the things we added here, we're keeping this for now just to experiment with it. But we show you the 30-day implied volatility for the stock lined up with the stock. And then for each option, we show you its implied volatility. Now, it's important to indicate that the implied volatility for this option is not the term volatility for this stock for the 15th. That's an important distinction. Every option has its own implied volatility. And when you see an implied volatility for a term, it's usually derived by taking the at-the-money implied volatilities, like the calls that straddle the current forward price and the puts that straddle the forward price, and doing some sort of interpolation where those four implied volatilities, or maybe more of them around them, are used to indicate what the volatility for that term is. And then when you have all the term volatilities laid out, you often take that and then interpolate them some way to figure out a 30-day or a 60-day or whatever the term is there. So there is no such thing as an implied volatility for Carnival at 30 days that you can derive just from data that's an immediate analytical like a calculation. Instead, this is an aggregate value that's somehow calculated from a variety of options that are all brought together. Just as something that comes up as a question a lot. So anyway, that's the implied volatility column, just to be aware of what that means. Then we go into intrinsic time and liquidity value for your options. So the intrinsic value of a call is the difference between the current price of the call and the call's strike price. So in this case, we've got a price for the stock that's it's over $56, and since it's a call, I'm sorry, we're talking about puts here. We've got the price of the stock at over $56, and we have a put here that's struck at 52.50. So it has zero intrinsic value because if you exercised it today, you would be basically putting the stock at 52.50. Whereas on the market, you can just go ahead and work with it at this 56.40. So it makes no sense to work with this option in terms of exercising it because the market provides better pricing today. As a result, the intrinsic value is zero. And in fact, if you were to exercise it, you would lose money because it would be a bad decision to make financially just because of what you can get with shares on the market. So that means that there is time value with the option. Since it's not worthless yet, there is going to be some time value. And the way we calculate time value is we take the bid ask and we calculate the mean. So in this case, it would be, let's say 22.5 cents would be the mean between the 20 and 25 cents. Now we take that and we say this is the fair market value of the option. Now it's not an exact science, and it's not always true, especially when you get wider and wider spreads, but we use that as a close enough here to give you a good measurement of what the time value is remaining in your options. So here in this case, 22.5 if we were to take that, multiply it by the 300 shares this represents, we would get $69. Would be the time value remaining in those options. But unfortunately, you can't go to market, and it would be very difficult for you to go to market right now and to get $69. As you can see, you're not being offered $69, you're being offered $60. So the difference between that is what we consider to be the liquidity cost. So if you're going to sell at the bid or you're going to buy at the offer, if you're going to do those things, then it would cost you $9 in order to do that. And what we do is we aggregate those out. So for each option we have here, and then we roll them up. So in this case, you can see in the Carnival book, there's no intrinsic value right now. There's $135 in time value tied up, and there's a $15 in liquidity that's tied up. So this just means that that's how you get to the $150 in value. It's kind of a different view into the book. It's sort of like a Greek's view, but it's a different angle on taking the Greeks. Since intrinsic is mostly delta and gamma, and then theta is what feeds into your time value, this is a way to break apart and say, all right, this is what I intrinsically expect from the book, this is what my time value is, and here's a liquidity. Now, a couple things of note. Liquidity is always going to be a negative number because liquidity is never in your favor as the investor. This is if you're going to go to a market maker and say, look, I need to close the deal right, or I need to close my position right now. You're going to pay them a little bit in order to be able to get liquid in your position. Intrinsic, if nothing's in the money, then it's going to be zero. When you see a negative number here, the negative number means that you owe, basically you are down that much money in intrinsic value. So in this case, we have a call spread that we are bearish on, where both legs are completely in the money and deep in the money. So as a result, since they're both so deep in the money, this is the full possible amount that if you were to exercise it, the difference between the current midpoint price and I'm sorry, not the midpoint price. This is the current value of that call between this price of the stock, the strike, and the call itself, where it's struck. So as you can see, right, this would be from 33.5 to get to 38 and 38.14. If you multiplied that by 900 shares, you'd end up with this number around $4,200. So that's why that's net down, and this one's net up. Like, we're doing really great on this call, but unfortunately that's a hedge call, so it's not the overall position. As you can see, rolls up, not particularly helpful. And the same down here. It also helps in positions like complex ones where we have this Exxon book where we've got a bearish spread and then a straddle, where we can see that, you know, we've got $76 in value in our favor, meaning that we have this net benefit of $76, and we have a net benefit of this time value here of $44. That $44 just means that if we were to close all our positions out, we would make about $44 if we were to get no liquidity cost. But of course, we are hit with about $16 in liquidity. These numbers are changing as we get new prices in. So that's just sort of a roll up. And then, of course, at our portfolio level, we could take a look at the total portfolio and calculate, we've got $165 from the loss in market value that's tied into what the liquidity is, having to do with the width of the spread and so forth. So you'll see this liquidity number at market open and market close should be pretty big. And then in the middle of the day, hopefully, as there's more participants in the market and less uncertainty, they will get involved, and this number gets smaller, and then it's big at the early part of the day, smaller in the middle of the day, bigger as you get towards the end of the day. So yeah, and if you have any feedback on this stuff, please let us know. I think this is pretty helpful. As an example, it helps you understand some of the rates here. So we can see that we know at this point for prices, we're up 120 on the Carnival trade, and we can see that there's 135 in time value remaining plus the 15 in liquidity. So assuming we say, we could probably shave the liquidity down, arbitrarily, then we could know that we've got about 120 of gain and 135 remaining. So we're nearing 50% of the potential profit on that trade. So that's just an easier way to look into that. There was one other thing I wanted to point out here, and this is more of just a meta conversation. For as far as Nvidia goes, it really sucks to be down over $23 a share, and to be down in a full loss of this option position. But one of the things I wanted to bring into perspective here is, we're not out yet. Obviously, there's 2 weeks, but we shouldn't fool ourselves into thinking there's going to be some big recovery. We will very likely take the full loss on this. And if we take a look at our option positions here, we can see that the full loss of $500, or the full market value of $500 down in intrinsic, like we're already at that point, and that little bit of time value here, a bunch of it gets sucked up by the liquidity. So there's very little we have, that we could pull out to go against this trade right now. So it's just like the Micron trade immediately turned on us. The Nvidia trade immediately turned on us, and we're just going to let it hang for a bit to see, because these 15% down days. Nvidia was trading at below 140 not too long ago, so it recovered up. It was at 160 on Friday at market close, so it could pop back to that pretty quickly. We just don't know at this point. We'll wait and see. It's not really worth closing out, but this is one of the potential benefits of options, is if you try to be responsible about your trading. Yeah, it's really terrible to get this drop, but the alternative would be if, let's say, we had placed a bullish position with just pure stock. Now, at the time that we did that, if we look at our positions now and we say we received $132 credit for a trade where we could owe upwards of $500 at expiration, which means that's $368 of value. Now, if we pull up the calculator and we say, all right, $368 of value. Now, if we take that, and that would be our maximum loss. If we divided that by the $23 a share that it's down today, that tells us that if we had owned 16 shares instead, if we just went out and we bought 16 shares, we definitely wouldn't have had the upside of the trade. I think in terms of the potential rate of return we could have gotten on our investment. But that's pretty much what would have happened today. If we had bought more than 16 shares, we would be down worse than we are at our maximum theoretical loss here. And this was part of the discussion I got into, where when we opened this trade, I had considered doing a calendar spread with calls, which would have been very bullish, and it would have bought the 160 calls for 6 months out and then hedged them with the 160 calls or 170 calls for like 2 weeks out. And it would have covered about 10 or 15% of the premium for the long calls, but this trade would be devastated right now. We would be down, it would have cost us a lot more to get in. If I think it was going to be something like $1,200 or $1,600 for the trade, we'd be down probably $1,000 right now. And so of all the various ways you can go in and trade these things, it's important, we keep our position sizes small. When we're trading directionally and we know that the losing everything is an absolute risk, it's important to not go overboard, and to not get too heavy in. Right now, like I said, I wish we weren't as invested here in in Exxon, but we do have a bit of a hedge here because in the event that even though our book will show us in our Greeks, if this were to rise pretty dramatically, we would go down in value, but it's not nearly as bad as if we weren't holding this long position, like these long positions to hedge our trades, especially this one. Right now, what's hurting us, or what would hurt us on a rise up here, is that we would be returning towards the mean of that 7150, and which was not the mean, but the point where we opened the straddle. That 7150 is the point we want to be as far away from for this trade to be successful, for us to make money on it. And we've got this bearish spread, which is really the net resulting in this 176 down, or rather, yeah, for the Exxon trade. So kind of a long-winded way to go about it, but the goal we have here is we want to see Exxon decline, and at the same time, though, we're kind of able to hedge a little bit against us, saying that if there's just a big movement leading into earnings that we weren't expecting, potentially like happened here with Nvidia, we would be softening the blow with this trade. We wouldn't, and potentially, depending on how far it went, if we take a look at managing our book, we can see that the potential for that big move, we could even overcome it. Like if it were to go up over 74, we'd even turn a profit from that moving up, because the gain in the straddle would more than offset we would have to move up to over 76, because the blue BICs are current holding. So in the event that were to happen, and we were to get a 10% spike or something like that, we could even turn a profit, because that straddle's gains would more than offset the spread's losses. But I don't want to go on too long. I wanted to get into some discussions we had some good feedback about the calendar earnings trade we did last week, and some other ideas over on Reddit. Probably save that for tomorrow. I think it's some pretty interesting stuff to talk about. But for the time being, we're running up over 30 minutes right now, so I'm gonna cut us off here. I'll probably take a look and keep an eye on this Exxon order at 70 cents. It doesn't look like we're going to close it out. We probably won't close it out today. I might nudge it up or down, but right now it's looking like we could get 80 cents as a price, which isn't too bad. But I really, I don't see this necessarily spiking up too hard. But then again, I was wrong about Nvidia, so who knows? As always, if you have any feedback, please leave us a comment below, or you can hit us up at hello@quantcha.com. And as always, good luck and good hunting.